All right. Well, good morning, everyone. A little bit of a delay here. As with anything, right? When you're trying something new, there's maybe going to be a little glitch or two, but hopefully you had a chance to refresh your coffee because we have a real good conversation coming up for you here. And we're going to get right to it. But I mean, this is a first for us. Like I said, we're trying something new, doing this live stream. And the idea really was around the fact that there's just so much going on right now. I know you have questions. It's confusing. It's a little bit overwhelming. And we want to just be able to provide a new way to be able to interact with you in real time. And so the important part about that is to actually get that interaction going. And so I want to invite you to use the comment section on the YouTube channel here to get engaged. We also we'll try some polling questions, and I guess actually with that we'll start with our first one, which really will be do you think we're going to see this significant change that has been talked about? The tax related provisions associated with the Build Back Better plan that would pay for the social policies that are being proposed. So do you think we'll see it? Yes or no? So we'll give you a little bit to get your answer in there. And while we do that, I'll invite the two that'll be providing a lot of these insights here today. So Tad Gudenbauer and Helena Bosovic. So welcome to Simply Tax Talks, the two of you.
Good morning.
Good morning. Yeah. And both of our national office tax group, and just been really just keeping your eyes and ears peeled for what's going on and following it and sharing that. So I wanted to, again, provide that outlet for everybody. So maybe before we get into the conversation, let's kind of see what what our polling results are here, if we can. And as we close that, we'll come back to that. It looks like 76% said yes. There we go. So pretty good amount of you are thinking that's a chance. And I'll say uncertain is the most frequent word I've been using. So let's unpeel that a little bit more, dig in a little bit more, and we'll start off with our top tax topics of the day. All right, Elena, I'm going to go to you on this, as I know you've been watching what's going on in the Hill. But last week we had some pretty big, public statements being made that maybe would see a shift away from tax rate increases on the corporate or the top individual marginal rates. And so maybe that means, the negotiations are going to shift. So, Elena, what are you seeing and what are you hearing? What's the latest with these negotiations, and how does that maybe play in, that rate comment into those negotiations?
Yeah, so for some context initially, so you have the Democrats, you have 50-50 in the Senate. So you have 50 Democrats, 50 Republicans, which means to pass this Build Back Better Act through the reconciliation package, Democrats need all 50 votes in the Senate. There have been two senators who have been the most outspoken on where they stand. So Senator Manchin and Senator Sinema have been the ones who have been kind of driving negotiations. So when you need 50 votes, two people can really sway things either way. So over the last couple weeks, we've seen Senator Manchin being the one pushing things because he's saying that he won't go over 1.5 trillion. So originally we started at 3.5 trillion for the cost of the entire package. And these last few weeks, the Democrats have been slowly dwindling that down. And I think the last we heard, it's sitting at about 1.75 to 1.9 billion, which is still, or trillion, sorry, which is still more than Senator Manchin is comfortable with, but it's kind of coming down to where he's saying, okay, I might support this now. So once they got the price tag down, and we're expecting a kind of end-all be-all price tag this week, Senator Sinema has come in this last few days saying, you know what, I don't actually support corporate or individual tax rate increases. The Democrats are looking at that as the primary way to pay for the bill, so increasing tax revenue. So once you take that off the table, all of a sudden you have, 2 trillion, or whatever the cost is going to be, and you have to pay for it somehow. So they're looking to raise money somewhere, and that's where taxes come in. So we've seen some of the tax provisions come into play this week under the negotiations as they try to figure out how to pay for this package they're putting together to push the Democrats' spending and economic agenda. And as of now, everyone's kind of looking at Senator Wyden. He is the chair of the Senate Finance Committee. He's been releasing tax proposals intermittently the last few weeks, and now everyone's kind of looking at those, I won't say random proposals, just because they didn't get a lot of limelight when he released them. But now that the tax rate increases are off the table, his proposals are getting some attention. I think the top two that everyone's talking about lately is the Billionaires Tax, which would essentially be a tax on unrealized gains of the wealthy. And we're expecting the official proposal details probably tomorrow, but it looks like it would probably impact those making over 1 billion in annual income or 3 consecutive years of 100 million or more in income. But again, we won't really know what that looks like. The latest details we have is a proposal Wyden released 2 years ago, and it's been said he's revamping that to an updated proposal. And then the other Wyden proposal that everyone's talking about right now is corporate stock buybacks, which would be a 2% excise tax on the amount spent by a publicly traded company to buy back its own stock. So those are kind of two big tax provisions that are taking over to replace the potential increases that were originally on the table for corporate and individual income tax.
Yelena, this is Tad. One of the interesting things about the Billionaires Tax Proposal, two things really to comment on is, one, they only estimate that tax would hit only about 700 people. That's a pretty narrow tax base, and when you're talking about this much of your revenue raise on simply 700 people, which obviously the rules aren't totally known yet, that's kind of an unpredictable stream of revenue, I think, in the future. So you're seeing a lot of pushback, or not a lot, but you're getting pushback really from Representative Neal, who is the chair of the House Ways and Means Committee, who feels that provision is way too complicated, which I have to side with him on that just from what we know of it so far. It's way too complicated, and again, the unpredictability of the revenue stream coming in from that tax. He is still pushing hard for what his committee came out with, which was the only real guidepost that we have right now, and that's the rate increases. So he's still making a little bit of noise about, his method is, or the Ways and Means Committee is a little bit simpler and might be, the better way to go. But I think at this point in time, that, as you said before, that's probably off the table, but he's still out there kind of rattling his saber a little bit.
Yeah, no, that's really interesting to kind of watch how these kind of get brought together, and obviously, yeah, to your point, Tad, you talk about being a little bit more simple, but also maybe just historically, more tried and tested. You start getting into a little bit more untested waters when you get over to, if you want to call it the billionaires tax or wealth tax or whatever, you want to call it. But there's definitely some issues and challenges that they would have to be navigated there. So I guess with all that, Yelena, what are you watching for then as the negotiations continue on here this week?
Well, everyone's kind of wondering where this is going to go because, again, we were looking at tax rate increases as corporate and individual tax rate increases as the primary drivers of the tax policy in this bill. Now that's off the table. All of a sudden, everything else that was kind of in the background or not even considered is being considered. So for the other tax provisions outside of the corporate buyback tax and the billionaire tax, the Democrats are thinking about potentially only extending the expanded child tax credit 1 year instead of through 2025. So if you remember, in 2021, the Democrats expanded the availability of the child tax credit, and they wanted to push this through for 5 more years, but it looks like that's only going to make it in for maybe 1 more year. There's also a proposal to have the IRS report annually transactions over $600. And that was mainly meant to help with enforcement for the IRS, but that's gotten a lot of pushback from banks and the Republicans. And so the latest we've heard is the Senate proposed maybe a $10,000 threshold and exceptions for common transactions, so direct deposits, mortgages, that kind of thing. But again, that's not really playing well in the media or anywhere else or with banks, lobbyists. So that's something that's on the table for potential revenue raiser, but again, not very favorable. They're also continuing to talk about increasing funding to the IRS to audit more of the wealthy. There's talk about a minimum book tax on corporations who have large profits but little taxable income. Again, we are still waiting on details on what that would look like as it's constantly changing from the original proposals released by the House a couple weeks ago. International tax is a big one that gets a lot of attention. So multinational companies, so U.S. companies with a lot of overseas income, we've seen a lot of talk about what that would look like. The complications there is the US is part of the OECD, and the OECD reached an agreement recently to impose a 15% global minimum tax. There's about 140 countries that came to an agreement to implement that by 2023. So we have some Democrats saying, you know what, why don't we hold off on any international tax, minimum tax, because we're going to have to implement this if it passes through the Senate and the treaty is ratified by 2023, and let's see what other countries do before we say we do something. So the original House proposal had a minimum tax on overseas earnings about 16% for a GILTI rate, and the global agreement is 15%. So we're pretty close, but some Democrats are pushing back on international tax changes until we come into more concrete agreement with the OECD. But again, that was a big revenue raiser as well, and so it's hard to just throw it out completely and leave it for later. And then the SALT cap is another big one. A lot of Democrats are saying we won't vote without some sort of SALT cap relief. So whether that's temporary or completely removing it, that's still in negotiation, and no one's been able to come up with a firm plan yet. But a lot of Democrats are saying that's a deal breaker on their vote. So there's a lot of different things going on. You also have climate change, energy initiatives is a big one, and a lot of it's energy tax credits. And climate change is a big Democratic platform item, and so they're trying to push that through this bill. But Republicans and some Democrats are saying, you know what, we don't support any of these programs. And so they've been kind of at the drawing board to see how they can work that into both the tax provisions and in the spending side of it. So it's a lot of moving pieces.
Yeah, one thing I'd throw in on that SALT cap, because that affects a lot of people, and more so in high tax states, but really even in some of the, I mean, I'm from Colorado, and we have a 4.63% rate, and it still affects a number of our people. But what we're hearing right now is that there is going to be a suspension for 2 years on the SALT cap for 2022 and 2023, and then it would come back in for 24 through 27, which is supposed to sunset out, I believe, in 27 anyway, but they'd suspend the cap for 2 years. And that one, if I was like I've said this before, if I was a betting man, which I am, that one I think is probably going to make its way into the law in one way or another, because there is just a number of representatives out there that are drawing the line in the sand. And I think their number is what, Yelena, 218 or 216 that they need to get, and they just don't think they'll get them without having that suspension in there for at least a couple of years.
Yeah, no, it's a delicate balancing act for sure, and all these things on the table. Maybe I'll ask your take on this too, because this is a common question. There obviously were a number of provisions beyond just the rate increases that were included in the Ways and Means version that we saw in the middle of last month, right? But there's two in particular that maybe, from my standpoint, as the East Region leader of our private client group here, hearing a lot of questions about the retirement provisions and those on grantor trusts. So I guess maybe I'll get both of your takes on this, since if, like you said, Ted, from a betting perspective, what do we think about the chances of those staying in, maybe, or keeping in the bill, maybe in light of some of these conversations around tax rate increases? Yelena, what do you think?
I think the grantor trust one, again, that's not really a rate increase. That's kind of getting rid of a provision that has long been a thorn in the side of the IRS, and been a real good provision for wealthy in their estate planning. So I think there's a good chance that may make it in there. But at this point in time, it's almost like all bets are off. In connection with anything that came out of the Ways and Means Committee, it's like they're starting over. But Yelena made a good point. I mean, they are just cobble crafting together enough revenue once they determine what the spend is. Because again, remember, this has to be, to get through the reconciliation process, they have to pay for whatever they're spending the money on. They have to have the provision for the pay for it. So once they know what the spend is, be it 1.5 or 2 trillion, whatever that number is, now they know what they have to go out and put together in terms of the raise. And this number here, from the perspective of the grantor trust thing, it's relatively large numbers to any one particular person, but I think in total, I'm not sure it's going to be that big of a revenue raise number. So I don't know, that may be going for it. But if they're just trying to throw everything against the wall to see what sticks to raise the money, it could be part of it.
Certainly. Anything you'd add, and maybe also maybe you could talk a little bit about the timeline here, because I know that's been a constant one we've been watching and seeing how things maybe have shifted. So yeah, what are your thoughts?
Yeah, so you have the Democratic leadership in the White House trying to kind of please multiple factions. There's a group of progressive Democrats, I think there's like 96 of them in the House, so that 96, if you need 218 votes, 96 it's a big number. You need all of them on board. And they're saying as a group, and they're saying, we will not vote on this bill or this package until you also, so there's kind of two bills kind of going side by side for context. You have an infrastructure bill that was agreed to in the House and the Senate. It passed the Senate. All it's waiting for is a House vote, and then it goes to President Biden's desk to be signed into law. And then you have these progressive Democrats saying, you know what, we're not going to vote on this infrastructure bill until you've come to a final agreement on the reconciliation package and get all of our priorities into this package. And so they kind of, I guess, holding the bill hostage until we can figure out some kind of way forward on the reconciliation package, which is being called the Build Back Better Act as of now. And so when the House was negotiating with Democratic leadership and the White House, they decided that Halloween was a good time, so that's the deadline they're shooting for, to get both of those bills voted on in the House by Halloween, which is coming up here in a few days. And so also you have Biden heading to Europe for a series of G20 meetings, and he wants to be able to say something that, the U.S. is doing something in Congress. And so the pressure is on, and the Democrats are saying, you know what, we're going to reach a framework for the Build Back Better Act, an updated framework, by Thursday, so that Biden has something to talk about when he goes to Europe, and they have something to vote on in the House, hopefully by the end of the week. But some Democrats are skeptical that that's going to happen, just because, again, they're still negotiating and no one knows what's going into this bill. So to know something by the end of the week is a stretch, but that is the deadline they're working towards, is hopefully to have a framework for the infrastructure, or framework for the reconciliation bill by the end of the week, in order to vote on the infrastructure bill by the end of the week. So
Yeah. We'll have to say, I think our audience is kind of skeptical too. We had 69% vote no, and our little poll we did here on whether or not we'll have a vote on the bipartisan infrastructure bill. So, yeah, we'll have to see. And I guess that's part of the fun here with these Simply Tax Talks, is we'll be back next week to kind of check in and see what happened and how it goes. But, I've always said this, that, it's so hard to know everything in tax, and it's so great to be part of a team and a firm that where I feel like I can reach out to people and get their take on things. And Tad here is one of those that I frequently find myself doing. So let's get to our next segment here, which is Tad's Takes. All right, Tad. So I'm dying to know, as I often am when I give you a call sometimes, kind of what's on your mind. So I'm gonna open up real wide here. Obviously we've talked a little bit about the reconciliation package and everything going on there, but yeah, what's on your mind that we haven't talked about so far?
Well, it's really kind of a practical problem that we have right now, and it's fairly timely. Is part of the bipartisan infrastructure bill, which I'm going to side with the 69% that said we aren't going to have a vote, in the House this week. Part of that, one of the provisions that they buried in the back of it, was they took away the employee retention credits for the fourth quarter of 2021, which we're in the fourth quarter right now. So the practical problem is that, the law right now is the retention credit is available. And if you remember, the retention credit is it's a very valuable, lucrative credit out there. At this point in time, it's, you got to meet certain revenue reduction requirements or some other alternative requirements to be an eligible employer. But basically, it is a credit of, up to, $7,000 per employee per quarter. 70% of the comp, that you pay for your employee. And I mean, it can lead to some pretty big numbers. And the way that you can monetize that credit, there are a number of ways, but one of them is to reduce your payroll tax deposits. Well, if there's a possibility that this is not going to be law in the fourth quarter, but you start reducing your payroll tax deposits right now, you're going to be in a practical cash flow crunch potentially come, the time period where they're asking for that money back. So it's a problem that are facing the employers right now. But, a couple of things to think about, as you're doing this. first of all, your third quarter 941s, which that's your payroll tax returns that are due for the third quarter, September 30th. They're not due until Monday, the 1st of November. If you were fortunate enough to be eligible to qualify for the retention credits in the third quarter and are claiming them on that 941, you might think hard about, as opposed to getting a refund of that money, applying it to your fourth quarter deposits. At least that way you're monetizing that a little bit quicker. Now, if they don't repeal the retention credit for the fourth quarter, then you can claim the fourth quarter ones either on a 7,200, which is the advance on it, or on your fourth quarter 941. But it's going to cause some real practical problems for those people who start reducing their payroll tax deposits now. If it comes into law that you're not eligible, it's going to cause some problems, which is why I kind of think that there's the longer that this goes on, where they don't vote on that bipartisan bill, the better the chance that that provision to repeal it will not be in it. Now, here's the practical problem with that is if they change anything in that bipartisan bill, now it's got to go back to the Senate for them to vote on it again. So that's where I guess I'm tempering my I guess enthusiasm for the longer this drags on, the better the result may be for the taxpayers is that I think that there's the practical issue that it would have to go back to the Senate. So just some real issues that we're seeing here with this, and we're also running into some issues with payroll providers who are a little reluctant about reducing the payroll tax deposits because they think that the rules are going to pass. Well, that's not really fair because the law is right now the retention credits are there. So I think again from a practical standpoint, what's going to happen is that if they do repeal it, they're going to give people some time, I think, to pay in those payroll tax deposits. They're not going to penalize you, obviously. They can't. I mean, you're following the rules right now. So, but there's a lot of moving pieces out there, and again, it just this uncertainty is what makes it very difficult for business owners and employers, to kind of plan for for their operations.
Absolutely. I couldn't agree with you more, Tad. And I'm definitely hearing that from the payroll provider. I was actually going to ask you that and to hear your take on that, because it definitely, I've seen the notices saying we're not processing and we're not going to consider the fourth quarter. But like you said, it's the law that's on the books right now. Right.
And that's the frustrating part to an employer is that, look, you're actually, you're making us, adhere to something that isn't even in the law right now. You may think it's going to be, but it's not. It's even worse and more difficult with, people who use a PEO, as opposed, professional employment organization. Because PEOs are actually technically the employer at that point in time. So it's even a bit more problematic with the PEOs.
Absolutely, it is. Yeah, no, that's a great point. I'm glad you brought up the ERC because it's been so huge for those that are able to take advantage of it, and then to have this kind of uncertainty, I guess, if you want to. It's probably the right word. Uncertainty with dealing with it is challenging. But we put a link in the comments here to learn a little bit more about the ERC. We've got a great flow chart actually that Yelena helped to develop that kind of walks through the two different versions of the credit and so forth. Looks like most of you are somewhat familiar with it, but that I know that's always my go-to whenever kind of explaining it or looking at it or unpacking it. So I'll point you in that direction. But
one thing to go along with that is that even if you weren't familiar with it until now or remotely familiar with it, just because first, second, and third quarter have gone away doesn't mean you can't go back and amend if you find out you really are eligible. So I would encourage you, if you even think you had some revenue reductions, again, these revenue reductions are comparing the year 2021 to 2019. So, in the revenue, it's usually it's a 20% reduction in your revenues. And if you think that you meet that, I would tell you reach out because these things are, I mean, they're a big damn deal. It's big numbers, and you would be surprised when you actually do the math on what those credits can actually be. So, reach out to anybody in your local BKD offices or to myself or Yelena, or Damien, and we can get you pointed in the right direction.
Great point, Tad. Yeah, there's definitely some surprises. You need to kick the tires on it, and the time's still here. We still have time on the clock to do that. So great suggestions. But all right, before we wrap up here, I always like to land with takeaways. I'm a takeaway kind of guy. So let's get the top takeaways for the day. All right, Yelena. So I'm gonna go to you. Kind of, I guess your closing thought, takeaway, and I guess what you're watching this week from the negotiation perspective.
Well, I think everyone's just waiting to see the proposals that Wyden is working on because those are the ones getting the most attention now that Sinema said she's not voting for anything with corporate or individual tax rate increases. So now everyone's kind of going back to the beginning and seeing what is going to be included in this bill because what we started with is not what we're going to end up with. So I think we're just kind of keeping our eyes out to see what proposals are released, and I think it's too much to hope for legislative text. We'll probably just have bullet points, but at this point, anything's more helpful because all we have is rumors on negotiations to go off of. So that's what I'll be watching is any kind of more detail on the tax proposals emerging out of negotiations right now.
All right, yeah, definitely a lot to keep your eye on. Actually, in our last episode, or most recent episode, I should say, of the podcast, we had Travis Lucas on it, who I know we're constantly talking to, and he was saying, keeping like Senator Manchin and maybe some of the others on an RSS feed and just kind of watching and seeing what's happening because there's just a lot going on. So, all right, Tad, what's your takeaway for the day? And
I'm gonna go back to the retention credit thing because that's real money. That's real time. That's affecting people right now. So that's a thing that I'm going to be watching, which is really then the bipartisan bill. And not so much obviously key into a vote, but where I'm going to have some disappointment is if they say the House is going to vote on it as is. So that's where I'm going to be looking.
All right. Well, I'll share a couple of mine here, and maybe before I do, I know Chuck, he had a good question there in the comments around, the thoughts around the proposal on the backdoor Roth IRAs and kind of maybe where that goes. So we do have an article maybe for those that are less familiar with that strategy. There's an article on our BKD Thoughtware about some of those changes and how they're proposed in the House Ways and Means bill as it stands right now, which again, Yelena, you kind of said maybe anything's possible, as things progress here. But yeah, maybe similar to maybe Tad's comments, I guess we might take on the grantor trust on the retirement side as well with the Roth IRAs and some of the limits they're talking about. They're actually they're scored similarly in terms of the amount of revenue they would raise, but it wouldn't be a tax rate increase. So perhaps, and again, you kind of have to look into the crystal ball a little bit here on it, but perhaps that means that because it's not a revenue or a tax rate increase rather, but a revenue raiser, that maybe it has a little bit more staying power. And, I guess they haven't necessarily been the most popular from the viewpoint of some at the service in terms of that two-part technique and the ability to do that. But I think they're still very much in play. The effective date for that actually goes out a bit into 2031. So there would still be some time there, I believe, at least, again, how it's drafted currently with the Ways and Means, the proposed text for markup there. But we shall see. Great question there, Chuck. So I guess what I'm looking at for the week is probably similar to the two of you, just trying to keep my arms around and my mind around what's going on in Washington and being able to help advise people, because really the time's starting to get a little bit narrow and short here, particularly from an estate planning perspective, a wealth planning perspective, an overall tax planning perspective. We've only got about 2 months left on the clock. So watching that, and it probably just goes back to the drum I've been beating here, which is, get flexibility, but start talking to your advisors and getting your team in place to make sure that, when we do know something, you can take action. So, yeah, I think that's kind of it in a nutshell. So this was fun. Thanks for joining us here today. Thank you, Yelena. Thank you, Tad, for trying out this live stream here. Hopefully our audience here today took a lot away from it. But I guess we'll have to queue up another coffee conversation here next week, if that sounds good to the two of you.
Sounds like
Works
a plan.
for me.
All right. Well, thanks again, everybody. Have a great day, and we will talk to you soon.